mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question from Marty. Marty asks, I'm planning to retire in about 3 years, but I'm worried about Social Security. Will it still be around, and how much can I rely on it? All right, Marty, that is a great question. And it's one I hear from a lot of people who are, they're in that 3 to 5 year window before retirement. Okay, according to projections, the Social Security Trust Fund could run out of reserves sometime in the mid-2030s. Right? But that does not mean that Social Security would disappear. It's important to be clear about that. Because I think a lot of people hear trust fund running out and assume the program ends. That's not how it works. Even without the trust fund, payroll taxes from current workers are expected to cover about 80%, 80 to let's say 85% of benefits. So the program would continue, it just might pay out less than currently promised. So the real risk may be a reduction in benefits if Congress doesn't make changes before then. And historically, Congress has always acted to shore up Social Security before allowing cuts to go into effect. Now, that doesn't guarantee that they'll do it this time, but the political incentive to protect those benefits is enormous. That's why many financial planners suggest preparing for the possibility that benefits could be 15 to 20% lower than expected. Not because it will definitely happen, but because it might. And you want to be ready. If benefits remain unchanged, that's great. You've essentially given yourself a raise. So you planned for less and you got more. But if they're reduced, you'll already be prepared. Your income plan won't be derailed. And this is a perfect example of why we stress building income from multiple sources: interest, dividends, and other income generating assets. Right? Rather than relying entirely on Social Security or portfolio withdrawals, diversifying your income sources in retirement is just as important as diversifying your investments. Great question about Social Security. And if you have a question about Social Security or anything else, send it in to us. Email that question to poollocke@poollocke.com. Moving on, second question of the day from Dennis. Dennis says, don't I need growth in order to hedge against inflation in retirement? Yes, another great question. And it gets to the heart of something a lot of retirees wrestle with. They feel like they have to choose between safety and keeping up with inflation. Good news, that's a false choice. Right? There are actually two ways to hedge against inflation in retirement, and neither one requires you to take on excessive risk with your principal. First, generate more income than you spend. For example, if your investments generate 6 or 7% income through interest and dividends, but you only spend 4% of that to cover your living expenses, the remaining 2 to 3% can be reinvested. Now, over time, that reinvested income generates its own income, and your total income stream grows. That's how you keep pace with inflation without selling assets. The second strategy is combining income investments with assets that still have growth potential. For example, dividend-paying stocks, companies that pay and regularly increase their dividends over time. Real estate investment trusts, which distribute rental income and can grow in value. Business development companies, they provide income exposure to private lending. So these investments generate income, but can also grow over time. They give you the reliability of income-focused investing with the inflation protection that comes from asset appreciation. So that means your income stream may rise in the future as dividends increase. A company that pays a $1 dividend today might pay $1.20 in 5 years and $1.50 in 10. That's income growth without you having to sell a single share. And if markets perform well, you may even have the option to sell a portion of those assets later to generate additional income. But it's a choice, not a necessity. That's a very different position to be in. So the key concept I talk about on this program, every video I have is simple. Income first, capital appreciation second. During your working years, the priority was growth. You were building the mountain of savings that would eventually fund your retirement. You could afford to ride out market downturns because you had time on your side. In retirement, the priority shifts toward reliable income. You need your money to work for you every month, every year, and potentially for 2 or 3 decades. And when you structure your investments that way, focused on generating income and protecting principal, it can provide a lot more peace of mind, even when markets are volatile. You don't need the market to go up to collect your dividends. You don't need perfect timing to receive your interest payments. That consistency is enormously valuable in a world of economic uncertainty. Great questions. Always good questions. Thank you so much. If you'd like to send in your question, please do so. You can email that question to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me